Hello, I'm Rich Checkan, President of Asset Strategies International. Many of you may be familiar with me or our firm. We've worked with Money Map Press and the various Agora franchises for a quarter century now. I'd like to welcome you to my presentation, How to Capture the Next Gold Peak, as part of the Money Map Press Black Diamond Virtual Conference. I thank you for attending. I thank you for taking the time out of your busy schedule to be with me here today, and I assure you it'll be worth your time. So the reason I chose this particular topic to talk about today is because of an incident that happened shortly after the last bull market. Gold and silver and the other precious metals rallied from 2001 till 2011, a 10-year period. And during that time, gold appreciated about 650%, silver appreciated about 1,000%. About a year after the peak, things were starting to pull back, and I went to a conference and I met a longtime friend and client there who greeted me with a phrase or a sentence I didn't want to hear. He said, "Rich, you let me down." And again, that's not something I'm looking to hear from a client. We're priding ourselves on customer service, and I pried a little bit. And he said basically that he had bought for profit, and I didn't tell him when to get out of the market. So of course, the problem here is we didn't communicate well enough. He always told me that he wanted to buy for wealth insurance. He wanted to hedge the dollar and protect his portfolio. He never communicated to me that he was buying for profit. And therefore, I didn't see the need to tell him to get out, because when you buy for insurance, you only sell if you have a financial crisis. And it was at that point that I realized that most investors, if not all, will say that they want to buy gold when they do for wealth insurance or for profit. But what they really want is both. The answer for everyone is somewhere in the middle, a little bit of wealth insurance motivation, a little bit of profit motivation, weighted toward what's most important to them. So I vowed at that point that I would come up with a strategy that would help our clients get out so they didn't get stuck in the market they were looking to profit from as it falls back toward a bear market. Taking a look at this current market, which is the second bull market in my 25 years in this business, there's a mixed, opinion on where it started. If you look back to August of 2015, the gold-silver ratio hit 80. That's a magic number. It indicates that the bear market for gold and silver is about to turn and enter a bull phase. It happened again in March of 2016. And right smack dab in the middle were the lows for the bear market. In December 2015, silver was at 1371 and gold was at 1,050 an ounce. And that was the bottom of the market. And a lot of people feel that that's the start of the bull market coming up from December 2015. Others suggest that gold broke out in 2019 in May, when it came out of a long 2-year period of consolidation at $1,200 to $1,300 an ounce. And then it soared like a hot knife through butter all the way up to $1,550 before taking a breath. And some people call that the start of the bull market. Whichever one's right, we're looking at either another 5 or 8 years of this bull market, because they tend to run 10 years at a time. So with that in mind, let's get on with it. First off is, who are we? For those of you who don't know us, we've been around a long time. Asset Strategies International was founded in 1982 by Michael Checkan and Glenn O. Kirsch. We are specialists in precious metals, rare U.S. gold and silver coins, and we also deal in world and ancient coins. So we're a dealer. We buy and sell. We're known in the industry over the past nearly 4 decades for our innovation, whether it be Birthman certificates, $100 face value bags of junk silver, bringing investment grade bars and coins of platinum and palladium to the market, or internationalizing IRAs, or putting domestic precious metals or international precious metals into your IRA. So we've done a lot of different things, have a hand in a lot of things for a while. What we're best known for is our customer service. Unlike most of the firms in our industry, we do not pay our sales representatives a commission. We don't want them um, making decisions basis what's best for them and their profit as opposed to what's best for you and helping you meet your goals. A lot of folks say they care about you and I'll advocate for you. We actually put our money where our mouth is. We pay our customer service reps a salary if they do their job, which is to listen to your goals and objectives and help you meet them. So let's take a look at what's been going on. First off, to understand what's happening, you have to understand the plan. And everything is still going according to plan, as spoken by Ben Bernanke shortly after the financial crisis of 2008 and 2009. He said after a Federal Open Market Committee meeting, FOMC meeting, when he gave his remarks, the following: if people feel that their financial situation is better because their 401k looks better, or for whatever reason, their house is worth more, they're more willing to go out and spend. That's going to provide the demand that firms need in order to be willing to hire and invest. And the critical elements here are, if people feel better, they don't actually have to be better, they just have to feel better. And they'll feel better if their 401k or their portfolio or their home price looks better and they feel confident and wealthy. Then they're going to go out and spend. It's all a house of cards. It's smoke and mirrors. And coming out of DC, the government decisions, the Fed, monetary expansion, et cetera, make sense if you understand what their end game is. It's about perception, it's not about reality. So when we look back at the monetary expansion, the unprecedented monetary expansion that happened at the end of the 2008-2009 financial crisis, the first question everybody asks me is, Rich, where's the inflation? And they go to the supermarket, they're not paying that much more for their tomatoes. The gas at the pump is actually cheaper as oil prices have come down. So where is that inflation that everybody expected when we expanded the money supply and diluted the dollar? I will tell you, it's in the stock market. Last time around, the Fed gave the money to banks and brokerages, and they said, okay, at some point, you need to lend this out to the consumers and let them spend it. Problem is, the banks felt the consumers were bad risk. They held on to the money. It was free, cheap, easy money that they could then invest themselves, and they started blowing up asset prices in the stock market. That unprecedented 10-year expansion of the stock market is the inflation from the last monetary expansion. Fast forward to today, we're in the middle of a pandemic, and governments around the world basically did the same thing. They shut everything down. Business ceased to exist except for critical industries. As a result, they killed the economy, but people still need to pay their bills. They have mortgages, rents, etc. They still have to buy groceries. They still have to pay for their insurance, etc. So what the government's doing this time around is they're putting the stimulus directly in the hands of consumers through stimulus checks, and they're putting it in the hands of small businesses through PPP, payroll protection program checks. As a result, we're not seeing the immediate monetary expansion, but we would expect going forward that this will turn into consumer price inflation once folks aren't scared about the next 3 to 6 months, once the economy starts moving again, and once we start getting to the position where we're ready to spend again. Okay? So what do we expect? Well, we expect what we have right now, deflation. Economy's stopped. Inventories are backed up. People are not spending because they're worried about the future. So we expect to see prices coming down and moving into, if we're not already there, in a recession, as the economy eventually starts to kick into gear and starts moving forward again. So it's going to be a sluggish period. Eventually, at some point, consumers are going to have the confidence to go out and spend amidst that recessionary environment, and we will see consumer price inflation from 1, 2, maybe 3 rounds of stimulus. That will lead to stagflation like we saw in the 70s. Needless to say, investors are flocking to gold and silver. As you look at the performance of the major indices thus far in 2020, for the year, the Dow Jones is down 3.2%. The S&P 500 is up, it's up 2.7%. The NASDAQ, the tech stock, and where we're looking for the answer to the pandemic, is up a little over 20%. Meanwhile, gold is up over 26%. Silver is up nearly 40%. And that's to be expected. You've got the worries of potential inflation, as I just raised, where eventually that consumer cash, that extra money in their pockets, is going to find its way into the economy. You're experiencing artificially low interest rates, so there's no opportunity cost to owning gold and silver. It's better to own gold and silver than to put it in a term deposit in the bank and get negative real returns. The US dollar is on decline. We've seen probably a year or two ago the dollar peak of about a 103, 104 on the dollar index. Anything over 95 symbolizes strength and a bull market for the dollar. The dollar has fallen over 10%, and it's down around 92, 93 on the dollar index, which is bear market territory. We've got a lot of uncertainty in the market about the virus, about social, political strife, an election coming up, etc. That all leads to market volatility. We're also seeing a fair amount of civil unrest, as we all know, as the gap between the haves and the have-nots was grown through the stock market growth and the events that came after the first round of monetary stimulus that went in the hands of the banks. The rich got richer, the poor got poorer, and that middle class is evaporating. So there's a lot of civil unrest out there, and as a result, we see safe haven flows into gold and silver, where people feel that they have the comfort and confidence that nobody manages or mismanages those assets. So let's talk about the first reason to own gold, and that's the first and foremost. It's all the time. I don't care if we're in a bull or bear market. I don't care if gold's at $200 an ounce or $3,000 an ounce. You buy it, you maintain your allocation, and you hold that position for a financial crisis you hope to never have. So by definition, gold as wealth insurance is the store of purchasing power with high liquidity for a potential financial crisis you hope to never have. Period, full stop, plain and simple. How do you manage that in your portfolio? Well, the first thing you have to do is you have to come up with an allocation. For me, that's 10%. It comes from studies that have been done which show that having about that much gold in a portfolio, regardless of how much you have in the way of stocks and bond mix, regardless of what currency you hold it in, it tends to increase portfolio overall performance, and it tends to decrease overall portfolio risk. So that's where that 10% comes from. It helps your portfolio. It is your golden anchor. It is your wealth insurance. So you buy it, you hold it, and you never, ever sell it unless you have an emergency. If you do, no matter what it is, to meet that financial need, you sell your gold immediately. No questions, no ifs, ands, or buts. You sell it, you meet your need, and then as soon as you can afterward, you go ahead and replenish to that 10% for the future financial crisis you hope you never have. If you don't have an emergency, great, good for you. Hold on to the gold, pass it on to your heirs, give them a start in life. You need it all the time for the times that you hope you never have. When buying gold for the right reasons, and that is the right reason, there is no such thing as the wrong time or the wrong price. Profit is a different thing. And I look to silver for profit motive, partly because of the relationship to gold. Gold is your leader in the precious metals complex. It will be the first to move up in a bull market. It'll be the first to move down in a bear market, okay? Silver and the other metals will then follow gold. And what we've seen historically is silver tends to outpace gold because it's in a smaller capitalized market. We look to compare the relationship between the two at a thing called the gold-silver ratio. Now, this is the number of ounces of silver it takes to buy 1 ounce of gold. And when you're down around 35 to 50 to 1 silver to gold, that signals the top of the bull market. When you're at 80, it's kind of a magic number, it signals the bottom of the bull market. So when you hit 80, you would expect gold initially and then silver to follow to start moving up. We actually hit a point about a couple months ago where the ratio was an unprecedented 127, a screaming buy signal, a screaming signal for the top or for the bottom of the bull market for things to start moving up again. Now, since silver will go deeper on the downside and it will go higher on the upside, that wider pendulum swing gives you a larger profit potential. And that's why we like silver for the profit motive. How do you not miss the top? Here we go. First off, emotion has nothing to do with anything when it comes to investing other than losing your money. So I look to the words of famous, probably one of the most successful investors of our lifetime, and that's Bernard Baruch. Bernard Baruch said, and I paraphrase, I don't care about the first 20% appreciation on any investment. He went on to say, I don't care about the last 20% appreciation on any investment. All I care about is that 60% in the middle. That's what he wants. And those are wise words. Basically, he's saying, you don't take a flyer and hope you're going to catch something that's about to rise. You wait for the trend to establish, and once it does, then you buy into it. And then you don't wait for the bitter end, okay? You don't stick around hoping to catch the very top because it's just not that important and the risks are just too high. You sell when you start to see the warning signs that things are changing, and then you pocket the meat, that 60% in the middle. So the way to do this is, one, you have to allocate. You have to say, okay, wealth insurance is all the time. I'm always going to have that. I'm always going to maintain that. For profit, you only do in a bull market, okay? You need to allocate how much you want to put toward profit potential. I tend to like an additional 10 to 15% of my investable assets in a bull market allocated to metals. I tend to weight that towards silver because of the potential. Now, here's the key. You constantly rebalance. The wealth insurance, again, you buy, you hold, you never sell unless you need to. For your for-profit metals, you must rebalance. Whenever you do it for the rest of your for-profit investments, whether it be 6 months, 1 year, whatever it is, you look at the market and you maintain that allocation. If the market has dipped and you have half the allocation you're supposed to have, you buy the dip and bring it back up to your allocated level. If it has increased in value, let's say you had a 10% allocation and all of a sudden now it's 20% of your portfolio, don't hesitate, no emotion, don't even think about it. Sell half. Book your profits. If you do that all along the way, you'll find that you're buying well and you're maintaining your allocation, so you're booking profits, and nobody has ever gone broke by taking a profit. If you do that, the top flat out doesn't matter, unless you can't tell the difference between the top and a bull market dip. Okay, so the way you tell that it's a bull market top is you look for the warning signs that this is about to come to an end. The warning signs that tell you I need to start looking for the exit now. Markets tend to last 10 years, so look for the decade-long market. Second, typically, historically, gold is going to hit 2 to 3 times its previous bull market high. Look for those levels. Look for that GSR between 35 and 50. Look for interest rates climbing. So now you do have a opportunity cost to own gold and silver once they get to decent levels. Look for sentiment. When your cabbie's telling you how much money he just made in the silver market, find the exit. US dollar climbing, bull territory above 95. Political and social unrest abating. And all of that leads to fear moving back toward greed for investors. That's how you identify that it's a top and not just a bull market dip. And if you do those things, like I said, the top flat out doesn't matter. You booked your profits all along the way as you bought well. So how can we help? Well, unless you take action, we can't help you at all. The first thing you need to do is get in touch with us. Call us, 800-831-0007, or email us at info@assetstrategies.com. We need to discuss your goals with you, give you some suggestions to help you meet them, and help you establish your plan. Then buy the dips and take profits, as I mentioned. We've got some tools to help you do this. We're going to give you access to our free newsletter, a monthly newsletter information line, and our twice weekly alert service, Always Something Interesting. We're going to offer you a free consultation. Call us up. I want to hear from you. I want to talk to you. I want to find out what your needs are, and I want to help you meet them. And as an enticement to get you to do that, we're going to give a free 1-ounce American Silver Eagle to everyone who makes a qualifying purchase. And I'm going to give you one better. As you get into this market, if you're not comfortable with it, if you haven't dealt with it on a regular basis, you may not understand it completely. We've got a free special report for money mappers that highlights the 10 most common mistakes and misconceptions in a gold bull market. And this is so critical because in a fledgling bull market, you are going to have people getting into this market as dealers that are just driven by greed and the potential of profit at your expense. They're going to charge you ungodly premiums. They're going to take advantage of you. Unlike us, who are after a relationship, they're after a trade and a profit, short term, and then they're going to get the heck out. They're going to leave you high and dry. So some of the things you can look for that you'll find in this report is the one question to ask every time you look to buy precious metals. First thing I ask is, when I'm ready, will you buy back? If the answer is no, run away. Because here's the thing, if they don't buy back, no matter how they try to explain it and paint it and make it look pretty, the reality is either they don't value what they're selling to you, so they should just give it to you, or more likely, they are so embarrassed about the high premiums they're charging you that if they buy it back, they would expose them, and they don't want to. If they don't buy back, don't buy from them, not ever, okay? Another point, ask them, do you take a commission? Do you work on commission? If they do, you know that they're chasing their own carrots and they're not there to be your advocate. If the first question a dealer doesn't ask you isn't, why are you buying gold? They have a problem, and therefore you may have a problem. So call us, 800-831-0007, that's 10 better than James Bond, or email us at info@assetstrategies.com. Use me during this virtual conference. I am here and available. We'll be available for live chats and video chats and emails. We'll answer your questions, take your calls. We want to be your advocate. We want to help you meet your goals and objectives so we can help meet our goals and objectives, which is to make sure you keep what's yours. Thank you for your time.